So I know a lot of people have been struggling with making some money on trading the DXY related pairs, so I wanted to kind of just make a short video, or could be a fairly long video, but just off going through the DXY and how you could have actually capitalized on it across the movement. So let's have a little look at the DXY on the higher time frame. So if we look at it on the weekly, we can see that obviously DXY is moving upwards, but it is moving downwards short term. So what we do need to understand here is that how can we capitalize on this? Well, if we are identifying price action, we can see how price has been moving. So price has been moving essentially like this, and from understanding that, we can then identify how we can take advantage of these pairs. So if we mark on that weekly little value area up here, we can then see that price tapped into the area, pushed down, corrected, and came down. Within that correction is where we would have potentially made some money, so we would have then identified price action and been able to take advantage of that. If we go into the daily, we would have then been able to identify the sequence that would have followed, which was basically this whole section here, and within that section is where we would have potentially made our money. So this is the idea of basically taking advantage of price action. So even though we've had this bit of structure here, we can then identify from here to that low how we would have taken advantage of it, and then depending on how price got there, we could have then taken advantage of price moving further. Now, even though price is moving sideways within a correction within this area, we can still identify price action to then take advantage of forthcoming price action. So if we look at it on the daily, what we can see here is that price taps into this area and then sold off. Was there any daily sort of area where we could have got involved? Yeah, absolutely there was, but really and truly, it's not where you're going to make most of your money. Most of your money is going to be made when you're actually reading through this price action and you're able to take advantage of it. So as we identify this as the daily low, we could then say, okay, fine, so from here to here, we can still take advantage of it and then see how price reacts to those lows. So then we go into the 4 hour, and then as we're identifying that, we can then see on the 4 hour, we're still getting very clean price action. So what I do like about this is that what we see is once we've tapped into that daily area, we've then actually given ourselves some opportunity. Where would the opportunity have been? Well, this would have been more on the higher risk side of things, where you would have had this action over here, which would have been trading through that low, and you could have then taken that trade into those lows there and then managed it accordingly into that price action there. So you would have then been able to take a trade over here, stops just above if you wanted to protect yourself a bit more, and you could have then traded it into that low there, stops there, and then if it continued moving, you would have gone lower, but you would have walked away with roughly around about 1.7. I think there was definitely room for more refinement on that stop loss, because you are basically playing that isolated structure there. So you would have been able to potentially just cover yourself there, and you would have walked away with roughly around about 3 point something, 3.5. Or if you were managing it a little bit more aggressive, you could have just walked away with 5 and then called it a day, because that was the end of the week there. So that would have been a 5% trade in itself. As we saw with the week that followed, what we then saw was, and I'll just clear that off a little bit. So what we did see was we had that as a little hook point high. That was the all-time high, and then we broke the low here. So at that point there, we don't actually necessarily know if price is going to continue or if price is going to be moving back to the upside. So what we could then see over here is that this is where patience would have been involved. You would have had to be more patient in these areas, because we don't know if price is going to continue higher or if it's going to come back down. So until we actually did this, so if we just mark on that low section here, which was there, we could then see price was corrective over here, and we could have taken advantage of this sort of price action here with stops there, and we would have then taken the trade here. Or you could have even refined it in there, but even so, you would have been in here, and then you would have just held that trade through and seen how it responded. You may have taken a break even, or you may have held through it, but either way, we can then see that there was actually a re-entry opportunity that came. So I'll just leave that one open and assume that we traded it and held that one through. As we look into the next trade, we can then see that we left this little footprint here, which was essentially retesting that area there. And then we had the rejection, and then it followed through to the downside. Now, this isn't the only way you could still make money. You can still refine this further, but just seeing it from a 4-hour perspective, you can see how you could have still taken advantage of it without having to go too low on a time frame, and you could have still got a moderately decent stop loss. And I think that is a very important factor to when you are taking these trades, because a lot of people will feel the necessary urge to refine and go to a lower time frame when it's not always the necessary need. So what we can see here is price then tapped into those areas, rejected on the 4-hour. Again, another trading opportunity there where you could have essentially taken the trade like that and then basically played the trade to here, seeing how it responded, and then as it followed through, you would have trailed it and been a little bit more aggressive in these areas. And then as it followed through, you would have had this trade, and you would have had the other trade which we had over there. Had you stayed in it, and you'd basically be running to the next point of call, which was down here. And then as price then approached those areas, you would be, in my opinion, a little bit more aggressive, because we don't necessarily know if we're going to be getting a larger pullback or not. So as you're running around about 4.7, you're probably locking around about, if you wanted to be safe, you would have probably had about 3 locked in. But we don't know how deep this pullback would go. And then obviously with this one, which is running around about 6, you probably just walk away with 5. Or somewhere in that region, just because, again, the same reasoning behind it. But had you just locked in around about 6 with both trades open, you would have then survived that run, and you could have potentially just played this whole run to the downside where price then came down here, and you probably would have walked away with 7 and walked away with around about 10, so 17% on that across both of those trades. So again, I think in terms of trading opportunities, there is a lot of trading opportunities. You don't always necessarily need to go to the lower time frames. You can stay on the higher time frame. So covering that, let's move on to the next point. So let's assume that you caught those trades and you walked away with 17%. Trades now further in the run. We can then clear off these charts. Don't necessarily need to be looking at too much. And then we can zoom out, go back to the weekly, and we can see how is price trading. Well, trade would have been around about there. So we understand that on the higher time frame, we are most likely coming back down to these regions. So you wouldn't necessarily need to be too aggressive with your trade if you did zoom out and you looked at it. And I think, again, that's another key point for a lot of people, is that you need to always be looking at the trade holistically from a higher time frame and not always zooming in too close, because then you're more prone to mismanagement, because you're trying to trade every micro movement, where you're looking at the bigger picture here, where we're basically trying to take the trade from these areas all the way back down into those areas and potentially further, because as we look at it outside, we can see that price has more than enough room to be moving like this, where we have a push down, we have a large correction, and then a push down, and potentially back into those areas. So the good thing about it is this video is being filmed at a time where we are basically moderately in the middle of this overall range, and we have room to go here. Now, will we come all the way to the bottom of this? We can't be certain, but we do know that at least around about, if we measure it, and this is a very essential tool that I'm always using, is I'll be measuring, where's the measurement tool? There it is. I'll be measuring from this high to that low, and then I'm looking at that about 15,000 pips, and then I'm taking that and I'm applying it over here, and I'm seeing, okay, well, that's moderately the amount of the range that's moving, but if we take it from the break, it could be moving back down into those areas. So looking at it like that, it does give you a nice eye of how you want to be managing your trade, and you can apply that to all time frames, really and truly. That simple tool is one that's probably going to keep you into a lot more trades and stop you from wanting to just come out of a trade out of emotion, because sometimes that's where a lot of people don't make the best amount of potential that they could have made, or they mismanage trades because they don't look at where the overall higher time frame picture is going. So if I go back to the 4 hour and we identify price action again, this is basically how simple it is. All we're doing is identifying price action, and then we're taking advantage of it. So as price came back down into those areas, again, we would have done the exact same thing, where we would have basically just boxed off that, and we would have then looked at it like, okay, well, we are trading into an inflection point where this could become larger and deeper, but then at the same time we are running in momentum and we're high up in the run on the higher time frames. So for that reason, I'm not looking for perfection, but I am looking to get protected well. So again, another potential trade in these areas, and this is where you kind of look at structure before candlesticks, because you're basically looking at the overall picture here. So you would have then seen price tap into those areas and reject. If I just zoom in a little bit more so you can see it closer, you would have then seen price action roughly around about here. And then in those areas, you could have just potentially just entered anywhere within their protection above. And then you would have basically just played this run. Now, the thing about this one is we did have a sharp pullback. So depending if you were running around about 4%, you might have walked away with less because you didn't know how deep it was going to pull back. And you may have even just mismanaged that trade, which is completely fine, it happens. But then let's just assume you did get tagged out of that trade. You would then have to be patient to understand that, well, this is doing what it's doing, but you're not getting the re-entry that you're looking for. And you may then potentially have to miss out on the overall move and then wait for the next bit of price to show its hand. So this is just something that I understood when I was looking at this, is that what is price continuously and consistently doing? Well, it's pushing and then creating structure and then retesting it and then continuing to the downside. And I'll just show you exactly what I mean. So we had this bit of price, we retested it over here, we sold off. We then had, call it this bit of price, we then broke above, we retested this area, created continuation where there was an entry over here, we sold off. What happened? Well, we retested that area there, we broke, remember we have that low there, we then created continuation, another potential entry there, we broke, we tapped into that low, we pushed up, we then retested this whole section here and sold off, entry in there as well. And then what happened? We broke the low, we came back up, we then kind of retested the low of this, we didn't commit, we came back up, we took out all of that liquidity, we didn't quite tap into that high, but then we sold off again. Now, we don't always necessarily need to tap into the sharp liquidity, but it's very probable and better for us to wait for it. If we don't wait for it, it's always better for us to wait for confirmation in the market. And what do I mean by confirmation? Basically what I mean is, let's just clear off the charts for a second. So I'll just clear this off. Okay, so what we have over here is we have this little bit of price action there, and everything else we're going to really not completely neglect, but we're just going to use the most recent bit of price action and isolate it to see, is this the piece of its own? And if it's not, then we can establish if it's coming back up, then we can look at the other areas, but more than likely we're just looking at this bit of price action here. What do we have? Well, when we isolate this bit of price in its own, we can then see that we do have a level of structure here where we have a 1, 2, 3 into that area. We pushed up, extended, and then what are we waiting for? We're waiting for price to come back in. We're looking for something more on the weighted time frame. We don't want to see anything on the 15 minute, 5 minute, 1 minute, 3 minute, whatever you use. We want to see something on a time frame that holds weight, and we want to see momentum coming in. Why? Because that's showing that the sentiment of, let's say, bigger players are now moving price into the direction of the overall trend, which is working as continuation with the trend. So then what we're seeing over here is that price has then given us that confirmation candle that we were looking for. And once we have that, we can then wait and see, do we have this? And we did. Now there was a little bit of liquidity above, but we didn't quite tap into it, and then we sold off early. Then what happened was we had this new spike over here, tapped into that liquidity, pushed away, and then sold off. Now this is something that I think is very essential, and if you don't know this, you should take note of it, is that sometimes when you have these massive spiking candles, you don't need to necessarily price hit into your structure, you can actually go through it. So what we can see here is that we actually then created this structure and then we continued. So there was a lot of mini lessons in that little video there, but I wanted to kind of point it out because it's something that took me quite a while to kind of just get used to and kind of just see through, where these little candles can sometimes put you off and you think that, okay, maybe this is coming back up and it's going to do something like that and then sell off. Well, you know, that is possible, but then at the same time you have to look at what's actually happening. And when you break it down the way I've just broken it down, you can see that by going back to the higher time frame again, which is extremely essential, is it really necessary? Not really, because we've technically done a lot. Now, what are we trading in? We're trading within this squeeze. So right now what we could see is price then sells off, comes back up, does that, continues, and then maybe we get something and it starts coming back up. Again, we don't know for certain what's actually going to happen with the price, but we know how we can take advantage of it through trading these structures. So it's about just really identifying the right structures in the right areas and then understanding how to play them, understanding when you want to be taking them at the top off when it taps into those value areas, and understanding when you want to be waiting. And as I've just shown you in those trades that we took, these are very situational because, for example, over here you would have had to wait. We didn't get anything which came in there, but then what we can see is, oops, I'll just pull that back. What we can see is once we broke above and we understood as a possibility, so we weren't always just sitting there unaware of what's happening, because everything is deliberate. What did it do? Well, it came back up and it retested that area. So after it did that and then rejected, we could have then taken advantage of this, taken a trade in there. And then if I just mark that up, what we can see over here is you could have taken it there. And yeah, even if you wanted to put stops above 43 pips, doesn't really matter. You know, at that point there, you're basically playing the trade into that low there. So then what we can see over here is that, you know, easily you're walking away with roughly around about 7% on that trade. So that would have been the whole trade idea. Now, obviously, we can see that price did pull up quite aggressively there, and you were running around about 5%. So around about that time, you could have potentially taken a discretionary manual close profit, depending on where it was. But then if you were somebody who was just trading it for the higher time frame and understanding the higher time frame picture, you would have survived this, and you probably would have walked away with roughly around about 7%, because you're basically playing it from A to B. And then at that point there, you would have then waited for a re-entry, which we did get, and we got the re-entry right here. Oops. Just pull that up here, got the re-entry right here. And then within that re-entry, there was potentially another trade for you, which was basically over here. So as we then came in over there, you could have then said, okay, fine, we've got that rejection off that value area, wait for the confirmation was there, and then you would have just taken it like that and then played that trade to just see where it went. Now, stops would have probably been around here, and you would have walked away with roughly around about 1% on that. It is what it is. Sometimes, you know, this trade could be the one that goes and it runs for like 4, 5, 6, 7, 8% before it pulls back. But in this case, it ran for about 2.5, came back, tagged you out for 1.1 or whatever. And then that's the trade you took. And then what happened was it further developed. Now, something that I was asked quite a lot previously was, how do I know when price is more likely to develop like this? Well, it's a great question, because what you do tend to notice is that if I go back to the daily, if you look at where price actually is positioned, it doesn't necessarily always make sense to see price just continue just pushing. It happens, but not always the case. It happens more so when you do zoom into the lower time frames and then you see these movements. But this is why I always say to people that, you know, you want to be careful when you're zooming in, because you could get zooming in caught up and then somehow get a bit of tunnel vision within that time frame, and then you kind of forget that bigger time frame picture, or you get positioned not in the best place possible, but you're trying to play the bigger move, and then what happens is you get caught up in this and this, whereas you try to get involved here thinking that's going to be the one to go, does that, and then goes. But because you took the loss there, you neglected the retest as a possibility, and then you missed the insurance entry trade there. Whereas I've noticed with a lot of the more successful and calmer traders, they understand that as a variable before they've even entered the trade there. So if price did do that, then they have the ability to wait, and then they can take that. And they understand that if that didn't come, they'll still wait and take the next one, and so forth. And they'd be able to play that trade from a holistic point of view. Now, something that Abji mentioned in a webinar yesterday, where he was at the hospital and he was on his phone, and when he looked at it on his phone, it looked much different to when he was on his computer. One thing you can notice about watching this video, when you can see the picture like this, very zoomed out and very clear, it's a lot easier to decipher. But when you're on your mobile and price action is looking a little bit like this in front of you, let's just say it's like that, it's very difficult for most people to then see what they need to see here. So they then isolate this, and then they kind of miss a lot of things because they're just kind of moving on the screen like this. So that's why I always say, like, you need to have your primary tool as either your tablet, your computer, or your laptop, and not your mobile, because your mobile screen isn't efficient enough to be giving you the whole picture, because it's not big enough. And if you you can look at it like this on your mobile as well, but again, it's one of those ones where you need to build that experience. So looking at it like this, another trade where you could have capitalized was probably on that one there, where you would have taken the 1%, and then you would have had to wait to see how price then responds to that area. But the good thing about it is it's not always about price getting there, like just getting straight there. It's about how did price get there, and then understanding that depending on where you are within the overall run, it determines a lot about price. So even on the daily here, I can see a daily entry, which was basically that big candle, and then you could have just refined it a little bit further, but I won't go into that today. And then if we go to the 4 hour, let's just say after that 4 hour close where we had the big rejection, we want to be waiting for that confirmation. So again, the trade there, you could have taken a break even or a loss, and then eventually you had the other entry there, and then it sold. Now, going into the original question, which was how could I have taken advantage of the DXY so far, and how would I have made money on it? Well, if we go and look at some of the DXY related pairs, let's have a little look at USD Yen, for example. Now, when you look at USD Yen, it doesn't look much like the DXY, because we can see the DXY had a larger structure and then pushed down. But what we can see is that it responds in a very similar way. So I think the USD Yen is positioned really well right now for shorts, because if we're seeing the DXY sell off, for example, what we're seeing here with the larger structure in mind, then we could potentially see USD Yen in a very prime area. So if we then isolate this and we look at it in the exact same way, and let's just say we put this here, we saw it reject, there's your 4 hour candle, right? There's your 4 hour candle. You take the 4 hour right there, and you'd go here, and then you'd basically play this trade. Now, again, you're not always going to be correct. You're not always going to get these trades on point, and you're not always going to have the patience to wait for these, because sometimes they don't come for a very long time. Like, we would have not exactly known that the trade would have been here. We could have thought maybe it'd been a week, so forth. But again, it's one of those things where if you build the correct habits and the correct lens to understand, identify these, you can get involved in the 4 hour in so many different ways. For example, you can see, oops, just clear that one off. You can see right over here, there was a 4 hour candle there based on the low, and you could have played that for the long, and you could have got involved here, stops below, and you could have got long. And then let's say that you did take that trade, you know, even if you took it there, you'd be walking around about 5%. Now, was there risk involved? Yeah, absolutely. It's a two touch. Could develop into a 3, could move against you. It's situational again. Like I said before, a lot of these trades you can take, but it really just depends if you're in a position to take the risk, and if you're not, you can always take it with lower risk. let's go to, okay, have a little look at this one. So this is our USD Swiss, and if I just take that bit off, what we can see here on USD Swiss is we had a 1, 2, 3 into this area, we pushed up and then strong rejection down, correction, and then sold off. Now it's not your cleanest bit of price action, because what we can see here is that we didn't really get the follow through from there. Then it corrected further, stayed within this block, and we're still within it. It's not the one that I would probably straight away be like, that's my go-to, but right now it's shaping up quite nice, because then if I take this bit of price action here, and with the way the DXY is moving, if we now break below this and then get some sort of, bit of correction over here, we can then take advantage of that and then get in to go short from there to the downside. And most likely, knowing USD Swiss, probably going to sell off, and we're probably going to meet those lows. So keeping that one in mind, again, this is how I'm utilizing the DXY's positioning, the higher time frame, and I could get involved. Let's say we get a 25 pip stop loss, into low. I'm still playing a 6-1, and I'm basically playing off the bat off, well, we have that structure, it then extended, it then created a bit of an extension there, pushed down, we got another bit of price action there, and then it just followed through. And then when you zoom out and you look at it on the weekly, it's like, well, yeah, it was always selling off, it was in a downtrend, it was just corrective. So you then took advantage of that bit of price, and I could apply that to so many different areas within here. Go back to USD CAD quickly, and yeah, so USD CAD, same situation. You look at the high time frame, and what's it done? It's tapped into that area there. Oops. It's tapped into this area here. It's then rejected, and now it's selling, and now we're looking in a very prime area where what we want to be seeing over here is rejection. So if I go down to the daily, what we can then see over here, which is beautiful, is that where we're positioned, we had that bit of liquidity there. We did the same thing that we saw before, where we came up to it like this, and we're basically then tapping into those areas, and then we can go into the 4 hour, identify a little bit closer, and then what we can say here is, okay, well, we have this little point here that we haven't really tapped into, fine, we have that little liquidity point there, and then we have this like lower part in here. Now, you're not always going to get price tap into those value areas, as I mentioned, right? But again, a lot of the time you're better off waiting for it to tap into them, because you just don't know out of experience at the beginning. But as you build that experience, you won't have the problem with waiting, because you're making money. So what we can then see here, overall, from a higher time frame perspective, we've basically done enough. We've tapped into that bit of liquidity, we've then pushed in, and then we're basically moving over here. Now if I go down to the 15, right, it's not really necessary, but I'll just do it anyway. You can then see over here, price is then now moving like that. So there is the possibility we come in here, we then push up, we get one more push up, tap into that liquidity that we were seeing, push down, get this, and go. Now that is a variable, but we have to also look at the neutrality of this, and what if the DXY just sells off and then USD CAD goes with it? Well, then that's why we then wait now, and if we see something like this, we can then take advantage of that in isolation. You then zoom out, go back to the 4, remove that, and then you look at it over here and you're like, well, has it really done enough? I'll remove that for a second. And then the real question is, well, what are we actually trading here? Well, if we're then looking at price like this, and then we're trading it into that low as a minimum, yes, it has done enough. It doesn't need to go higher, actually. In fact, it's breaking, it's moving to the downside, and if we do go, then we could actually take that trade and manage it into there. Okay, great. So what sort of stop loss are we looking at? Well, if I go back to the 1 hour, and let's say that we did take a trade here, and I think USD CAD is pretty reliable. Spreads are not too crazy on it as well. I could probably get in with roughly around about 12, 10, 11 pips. Even to that low, I got 2.5. and then I could probably break even that trade anyway. And then if it does follow through and keeps going, then I'm in for a pretty decent run because there's not much to the left. And then yeah, to the low I'm looking at 18%. Now a lot of people might be like, whoa, 18%, that's insane. Well, that 18% only comes to the patient trader, to the trader who's willing to survive through the move. It's willing to stay out of taking his profit when there is certain pullbacks, because he understands the bigger picture, but then also at the same time he understands why it's moving, and then he can read through it and see the DXY as well and be like, okay, I know exactly why I'm holding on to that trade, I know why I'm staying in this trade, and so forth. So again, so much opportunity, so much trading opportunity, so much understanding behind it. I hope it was really useful. I know that for a lot of people, you're still trying to get consistent, still trying to make money, and don't get me wrong, I'm still in the journey as well. It's just one of those ones where I think a lot of the time we do get into our own head, and because we get into our own head, we end up trying to rush things. And I think when we get into the mindset of trying to rush things, that's when we start getting complacent and making mistakes. But really and truly, price action is very clean. It's always been there, it's always been very clean, but it needs time to develop. And if you can't wait for price to develop, then you're going to get caught out a lot of the time. You can't get upset with the market because you got a trade over here and then price pulled up, tagged everyone out, and then eventually sold off. You can't get upset with that. You need to adjust, you need to pivot, you need to adapt with the market and understand that these are things that happen, but you can control yourself, but you can't control the market. And the great thing is, if you could stay well-rounded and create a strong mindset to understand that, fine, you know, that was an anomaly, it happens, I will wait. And then you get an entry, may it be here, may it be up here, you know, wherever it was, you get an entry, and then you manage it accordingly, and you just keep repeating that process, and that's what's going to yield you long-term results and build a strong, sustainable mindset. So again, guys, hope you enjoyed this video, and I look forward to catching you all in the next one.